Good morning, everybody, and welcome to our autumn update. We're not having a poll today, but if we were having one, I would be asking who thinks that we can have a face-to-face presentation again sometime this year. If the results were based on hope, I'd say that most of us would say yes, we definitely hope so. In the absence of that, we are here today live to talk to you about multi-asset funds and the opportunities that we see in investments at the moment. We've seen an amazing rebound. I mean, who would have thought that we'd see such a strong recovery from a year ago? But what do we do now? It seems to us that investors are all climbing the proverbial wall of worry at the moment. We worry, is it going to last? We worry about what we've missed out on. We worry about low interest rates, all of these things that we need to work for us in our portfolio. A few years ago, investors were complaining that multi-asset funds gave them nothing, no return over 5 years to speak of. The last year's recovery has actually started lifting those numbers to something a bit more acceptable. However, in the meantime, a lot of people have taken their money out of those funds. These funds used to be the bedrock of building a long-term retirement strategy. Our diversified income fund, our stable fund, and our balance fund, all our Reg 28 multi-asset funds, these kind of funds were all a solid building block. And what we've seen over the last few years is that they've fallen out of favor. Over the last year, the balanced category has done around 30%, and that compares to a 5-year number that's now gone up at least to about 5% per annum. So the last year's recovery has had quite an impact, a compounding impact on those longer term numbers. Stable category has done just under 20%, and their 3-year number has gone up to about 6.5%. So you can see the impact of that one good year that you need to be there. The format for today's presentation is we can have 2 speakers followed by a Q&A. So again, we can't be with you in the same room, and we miss interacting with you and be able to answer your questions. So what we've decided is to make the presentation shorter and add a Q&A at the end with questions that we've received from you. There's not going to be an assessment, no exam at the end. I always found those quite stressful, and you have to go and rewind back and figure out what the speakers actually said. But the presentation is time-stamped, so as long as you stay on for the duration of the presentation, you will get your CPD points automatically. I'm going to hand over to our speakers now. Our first speaker is Justin Fleur, in charge of our balance fund, and he'll be followed by Dirk Jooste. Both of them are involved in our multi-asset products, and they've also been in the market for over a decade. So over to Justin. And thank you again for attending. We know that there's a lot of webinars around, and thank you for choosing this one.
Great, thank you. Thanks, Annette. Welcome, everybody. Yeah, thank you for dialing in today. We really, really appreciate your time. It's a beautiful day here in Cape Town, and I'm looking forward to talking to you a little bit about multi-asset investing in these extreme markets that we're in. I think if you just flip back a year or so, a little bit over a year, I think this image captures some of the feels that we all went through. Pretty unprecedented times, and a lot of new and strange developments, things that we've never seen before in our lifetime, and we might never see again, quite frankly. And it's been a challenging time, but also a surprising time. A lot of good surprises buried in there with the bad surprises. I think I'm conscious of 2 categories in our audience today. Those of you in the audience that are supporters of our funds, that are in our funds, I'm cognizant that it's been a challenging number of years, particularly in our higher equity funds. And we just want to say we thank you. We appreciate your support. We hope you have been enjoying the more recent performance. But I'll touch a little bit on where we are, the context that we're in, and what our expectations are in the future. For those of you in the audience who are observing us, who are not yet partnering with us, we hope that you'll find the session useful as well in your journey to come alongside your clients. And perhaps there'll be some food for thought for you to consider partnering with us as well in the future. So what we're going to be discussing today, I think I want to take you through just a little bit of the big picture that we're in, give you a little bit of context, I promise you it's not going to be a macro dump. That's not what we do at PSG Asset Management. I'm going to touch on briefly our investment approach, how we manage and steward our clients' capital, particularly in the multi-asset fund framework. And then I'm going to hand over to my colleague Dirk, who's going to lift the lid on our portfolios and get you a feel for what's actually going on there and what our outlook is. And then we're looking forward to the end, a bit of a fireside chat where Dirk and I will be quizzed by Annette. And thank you for all your questions. We really look forward to responding to them. So a little bit on the big picture. I think a good one to start with is just to think a little bit about what markets have done over the last year. And this is data in rands over the 12-month period ending March 2021. And I think it captures quite nicely what's happened since the coronavirus crash kind of hit us and hit the markets early last year. So a couple of surprising things on this chart. Number one, our rand has been pretty impressive. It's strengthened 17% against the dollar, obviously from quite a weak starting point. But I think that has surprised many people. And South African markets, particularly in rands, have actually held up really, really well. So we've recovered quickly. The all-share index up almost 70% on a 12-month basis. Even the hated property sector, not putting in a bad showing. And even bonds, after a bit of a wobble last year, have kind of stabilized quite nicely. Cash, a bit of a challenging environment for cash. The lower repo rates obviously dampening those returns further. And I think Dirk will touch on that a little bit later on. On the offshore market side, I think you'll see some familiar statistics there. I think quite an interesting divergence between equities and bonds. I think we've seen this type of bond pain, especially in rand terms, that we've seen over the last 12 months. It's been quite a difficult place if you've been sitting in US government bonds. And then in the commodity space, very interesting. Gold had a nice run up halfway through last year, and it's given a lot of that back. But some of your more growth-oriented commodities, copper, oil, have been surging. Now that gives you a little bit of context. I think it's useful also to just touch quickly on the 12-month performance over that same period in the multi-asset funds that Dirk and I will be speaking to today. The balance fund and the stable fund. I think what you can see is pretty pleasing outcome over the year, but it's in the context of quite a challenging period, and we think there's a lot more wood left to chop there. So I'll come back to that shortly. I think if you just step back, I think a very, very, very important phenomenon that we're looking at is the sheer extent of policymaker response. What this chart shows you in red is the cumulative GDP erosion, so the loss that we saw in the recession in the first half of last year. That's the hole that needed to be plugged, and boy, did policymakers plug it. I think what you can see in the subsequent charts is that the US fiscal stimulus announced so far, very substantial government spend in 2020, $3.4 trillion. And then this year we've had the American Rescue Plan announced as well, almost $2 trillion. That ignores two other very substantial packages which are still being deliberated and debated, namely the infrastructure plan and the proposed American Families Plan. In combination, this is multiples of some of the pain that we actually saw, and this comes at the same time as monetary stimulus through the form of quantitative easing is reaching all-time highs. So the Fed balance sheet is up 80% over the same time. So we're in quite a unique period over the last year where we see crazy fiscal stimulus, really, ludicrous mode, to use the parlance of Tesla times. Those of you who know, that's the very fast mode if you drive a Tesla these days. Coupled with a very, very, very big central bank response as well. Now, what does that mean in combination? Probably a bit of this. Okay, so from, I think, really, really dire times, being down in the dumps last year, I think you're seeing some parting happening on the market stage. And it's quite interesting to just lift a little bit on it. You're seeing signs of quite intriguing speculation. You're seeing retail investors entering the market for the first time. We all know about what happened with GameStop and those type of shares earlier this year. You're seeing the crypto boom kind of resurging. We have one every few years. This last one is a doozy, it seems. So that's in there. Markets kind of surging to new kind of all-time highs. And generally, it's been a good time if you've had money in the markets, especially if you put it in the lows of last year. So allied to the markets, at the actual economic level, you're also starting to see some interesting data come through. As vaccines, particularly in the developed markets, start accelerating, the world is looking forward to a grand reopening. People are scheduling big holidays for the first time. They're sitting with flush savings accounts. Household savings in general across the developed market are very, very strong. And I think there's a lot of pent-up demand there. How is that all going to end up? We don't know, but it does remind us of something that happened almost exactly 100 years ago. Exactly 100 years ago, you had this phenomenon called the Roaring Twenties. And it's quite interesting just to think about what happened there. It was started immediately after World War I, and interestingly also a very large global epidemic. It's a very serious one. Actually, far more people died in the Spanish flu than actually died in World War I. But that was really the start of, or it marked the start of this Roaring Twenties decade. And there's some very familiar themes to what we saw then and what we see now. I think if you look forward for the next year or two, certainly, booming economies as we have a synchronized recovery. I've already spoken about asset prices. That was a familiar theme then as well. Following the war, following the Spanish flu, you had a very similar environment. If you had invested money in the stock market in the 1920s, you would have done very, very well. It was a time of technological advances. The motor car, radio, some of these technologies that we take for granted today were new. They were cutting edge. They were our blockchains. They were our fintech. They were our digital-enabled technologies that we're seeing today. And it's quite an interesting parallel. And I think very consistent with the pattern that we've seen previously. It wasn't all good. It was also a time of very, very profound political and societal tensions back then. Women's suffrage, the right to vote, in particular, was very, very pronounced following World War I. I think today we see that echoed around the world, including in our own country. I think very, very profound political and societal tensions that are working themselves out. And then finally, back then, after the flu, after World War I, guys were ready to party. There was pent-up demand. People wanted to get out. People wanted to invest. People felt good. The confidence was up. And I think we're seeing some similar signs of a similar journey at the moment. It is a bit sobering to think about how that decade ended, however. I think we just to remind you, at the end of that decade, in 1929, we had Black Tuesday, and it was followed by a number of subsequent crashes. So the stock market crashed, and it was the start of a very, very painful period in economic history, the Great Depression. Started in the US and really expanded across the world. So what does that mean for us today? I think there's some very interesting similarities. And to use an analogy of a train, I think, the starting station are very similar, both started by, around a very, very serious pandemic. We're on the train at the moment, it's moving. I think there's some similar themes that we're experiencing to what we experienced then, and it's important to think about those when you're constructing a portfolio. We don't know how it'll end, though. So we have no insight into terms of the final destination, but we do know it will end eventually. And it's important to be thinking about that in your portfolio construction as well. So that's a little bit of context for some of the global picture. Just to come back to South Africa, where are we in terms of the domestic environment? It's tough. It is not easy. It is not a cakewalk. There's a lot of disappointment, I think, that we all share as citizens. But I think I would characterize it as tough, but getting better. Certainly over the last year, we've seen some positive surprises. We've seen revenue collection come in better than expected. We've seen very strong terms of trade. Our current accounts has surprised a lot of people. The rand, I think, is a symptom of that. And corporate earnings. Some of our companies actually showed a remarkable ability to weather the storm of last year and actually come out stronger on the other side. So some surprising developments there. It's pretty steady. I think very, very unsatisfying progress. We can all point to things like Eskom. We can point to a very, very slow and disappointing vaccine rollout program so far. But it is progress. And to use the analogy, it feels like a bit like a baby learning how to walk again after 20 years of regression. And 2 steps forward, 1 step back, but steady as she goes. I think she's getting there. On the flip side, sentiment is very, very weak, and that means that assets remain extremely cheap. So when we look at the domestic environment, we're still finding a lot of opportunities there. despite some early signs of progress and some reflation in some of those asset prices. So we'll come back to that a little bit later. It's quite interesting just to flow back to what we said previously to you. So in September last year, I presented to you, those of you who were there might remember this, and I presented this slide. And I think what we were communicating then, it was a really tough time. Markets hadn't started working yet. And what I said to you was, business confidence comes in these grand cycles. And last year, September, it looks like we bottomed at the most extreme one we've seen yet. So the chart on the left is your business confidence index. And what's quite interesting is just measuring subsequent returns in equity markets from those low points suggested that you always did well by buying at times of pessimism. And I think what you saw on the right-hand side is SA Inc. shares, which is a selection of shares focused on the domestic economy, and the general all share. And I think what it showed is it paid to be brave. It paid to invest in South Africa when everybody else had written it off. Now, at the time, we didn't know what was going to come. We were looking at uncharted territory. What we said was that the history looks interesting, and it looks probable that you'll get a good outcome. Now, it's interesting just to kind of look back 7 months later and see what's actually happened. So 7 months later, it does appear that the pattern is starting to repeat again. So on the left-hand chart, you're starting to see business confidence bounce back a little bit, still well below neutral levels, but that green line is showing you some sort of recovery. And then very encouragingly on the right-hand side, you're starting to see early signs of outperformance in SA assets. So SA shares in particular are starting to surprise on the upside. Earnings are coming through better than expected. Ratings were very, very, very low. There was so much bad news priced into them. And I think if we look at the previous cycle, that can sustain itself for a number of years. So we're 7 months in. We think there's more to come in this space. So to maybe just dwell a little bit on our approach and how we hope to harvest that opportunity for our clients in a responsible and consistent way, it's worth just touching and reminding you in terms of what we do and how we do it. So those of you who've walked a journey with us for a long time will be familiar with this. What we really do in a nutshell is we look at opportunities and we try and assess the intrinsic quality of them. We look at things like moat, really capturing the competitive advantage and competitive positioning of a company in a certain industry and its prospects. And then we look very, very carefully at those individuals and teams and people entrusted with stewarding that capital and allocating that capital over time. So it's a moat and a management focus. A lot of work goes into that. We really try and do deep, thoughtful research. And really what we're trying to do is we're trying to identify companies that are good inherent companies that are maybe out of favor at the moment. Maybe they have some sort of temporary problems. And the analogy we'd use is diamonds in the rough. It looks like a bit of coal. You pick it up, doesn't look that great. You do a bit of polishing, you actually realize there's something quite special underneath. And that's really at the heart of what we try and do. And then we try and make sure that we pay an appropriate price for that underpins the return our clients can get from that opportunity. And the 3 legs of that bar stool is at the core of our process. Now, up to now, especially the last couple of years, that price leg hasn't added much value. And the reason for that is that the markets so far, certainly up until March last year, had largely shunned valuation as a tool for recognizing value. It almost didn't matter what price you paid. People were followed on growth, on momentum, on blue sky, and price didn't seem to matter. Now, it does look like that's starting to change, and a little bit like gravity, these things always matter in the end. So just to kind of showcase that a little bit, it's worthwhile just looking at the lens of the balanced fund. It's the fund that I'm responsible for. And I think what I want to show you here is really 3 main points that I want to make. The first point I want to make is that over long term, this consistent process that we've applied seems to have added value. We have delivered returns since inception ahead of the peer average, well ahead of the peer average. So that's point number 1. What we do seems to work. The second point, apologies for that. The second point is that there are times of underperformance in there. And particularly there are 4 points in there that I'll draw your attention to in the next slide. And the final point is that we typically do well coming out of those times of underperformance. So just to kind of show you what that means, what I've done here is I've shown you those four episodes that are kind of just worth drawing out. 2009, the fund underperformed its CPI plus 5 benchmark on a rolling 12-month basis by about 32%. That was obviously just after the financial crisis. You had a couple of other episodes which were more muted. 2016 was a notable one. We were early in resources there. Some of you might be familiar with that. And I think we lagged the market quite substantially. And then more recently, it culminated in March last year, was the deepest and longest one we've experienced so far. What is quite interesting, though, is that the subsequent performance, both on an absolute in green bars and relative to our peers in red, from those points have typically been very, very strong. So our best years typically follow tough periods. Will that repeat again? I think, we don't know. So far, it looks good. Performance, as we showed you earlier in the presentation, from March to date has actually been pretty pleasing. But there's a lot more to go. We think there's a lot of wood left to chop here. And to kind of give you a sense on how we're doing that and to lift the lids a little bit on that portfolio, I'm going to hand over to my colleague, Dirk. Thanks, Dirk.
Thanks very much, Justin. All right, so I will take us through a little bit just in terms of our investment positioning. So just to set the scene from a high-level point of view, we will look at our current portfolio strategy. We will look at areas of the market that we are favoring and contrast that to the segments of the market that we are avoiding. So starting off on the favored side, domestic shares, they were very attractively priced coming into the crisis and got even more cheaper as the year progressed during 2020. Now, our assessment is that the longer-term prospects of this segment of the market hasn't really changed much. This segment of the market is severely neglected and has faced a trifecta of foreigners that's been multi-year sellers of this space. Local institutional investors, relative to longer-term averages, are very much underweight in this area. And we've seen retail investors favoring cash and offshore equities, making it a very uncrowded area. And we think this is a very fertile area. And specifically relative to our peers, our size, we are still able to exploit this to a meaningful degree within our funds. Globally, we've never seen a divergence as what we've experienced or witnessing at the moment in terms of a huge spectrum of valuation differences between different areas of the market. So we're very selectively in terms of global shares, but we're still finding very attractive opportunities in the global context. Similarly, looking at resources and material companies, also very selective, very careful in terms of the basket of commodities that we're exposed to, and as always, very mindful that we pay attractive valuation for that exposure. Listed property, we've had some exposure over the past few years in terms of offshore property. Most recently, we've added, just given the sheer train wreck that the local property market has experienced, and which was accelerated by COVID, we're now starting to incrementally add in that sector. And we have a mild bias to the retail property market. Government bonds, we're well aware of the fiscal challenges that the country faces, but we feel that the risk premiums embedded in government bonds, specifically looking to the mid to longer part of the opportunity set, seems to be excessive. And one niche area that we're taking advantage of in our multi-asset funds is an inflation-linked bond market area of this segment. And we think it's a very elegant way, just in terms of an alternative to various aspects of our portfolio construction. Areas that we are avoiding, expensive momentum-driven shares. Our sense is that the market has become quite insensitive in terms of the price they are paying for certain assets in the market. And forward-looking, we think the expected real returns on offer in those segments of the market look quite dismal. Long-duration equities, just considering the multi-year low interest rate environment that we've experienced, these are typical equities where there's an expectation for strong growth to emerge in the future, and those cash flows then in turn being backdated. But we still, just relative to this tailwinds that they've experienced, we have some concern just looking forward. Global bonds, it goes without saying, specifically looking at developed market bonds. There's no other area in the market where it's more explicit. Just looking at the yields on offer, you're pretty much guaranteed to have a negative real return outcome. Credit, local and globally, we have just this challenging environment where lots of investors are trying to solve for a low yielding world. Credit spreads have contracted on that basis, and we think the risk reward is quite unfavorably skewed in that segment. Lastly, looking at cash, in terms of our process, we have a large appreciation for cash and the intangible benefits that it can bring in terms of firepower and optionality. However, with the Reserve Bank cutting the repo rate down to 3.5%, we've been open-minded in exploring alternatives. Overall, a very interesting environment to be investing in, lots of opportunities, but we believe a lot of risk. So these extreme markets call for an open-minded attitude. So maybe just getting a little bit more granular and looking at the PSG Balance Fund, we're just assessing here the different broad asset categories and the change year on year in terms of our positioning. The blue bar will represent broadly a year ago, with the yellow bar more recently, and then the red bar will indicate just the changes in those broad asset categories. We've also added a black line which represents the longer term average for the Balance Fund, just to give a sense relative to history how we are positioned. Quickly touching on SA equities, we've increased our exposure mildly over the year as a result of the attractiveness of the opportunity set. Foreign equities, a slight reduction. I think this is a function of a re-rating on some of our foreign equities happening at a different pace to SA equities. And I think that's a very subtle but a very interesting just point to be making for a multi-asset fund. This concept of asset classes and equities moving at different speeds in a multi-asset fund can respond and take advantage of the flexibility that it has to reprioritize into the more risk-adjusted, attractive areas of the market. Property, you will see from a longer-term perspective, we haven't had lots of exposure. We've had some exposure to offshore. Currently, we incrementally adding. We think a lot of the fundamental concerns we've had longer term are now starting to be adequately reflected within asset valuations. But it is most definitely a stock picker market. We think there will still be quite a few casualties in that space. In aggregate, when you look at our total growth assets, you will see by the blue line, and relative to long-term average, we entered the period in terms of prior to COVID with a slightly offensive positioning. And in light of the opportunity set, our positioning has grown incrementally a bit more offensively relative to long-term history. We've reduced some of our bond exposure. We still think this is a very attractive area of the market, but we've reprioritized some of that capital, allowing us to fund some of the more offensive positioning we have at the moment. Just lastly, cash, just relative to the opportunity set, the Balance Fund has taken advantage of. We've been running with fairly low levels of cash, and this holds true today as well, just given the very low interest rates environment. Quickly looking at the fixed income investment universe, we've seen a profound recalibration of the opportunity set. What we are showing you is the yields that were on offer 2019. We're contrasting that to the yields as of March 2021. We also show in the blue line the long-term CPI expectation. We've just for illustrative purposes, we've used the midpoint of the Reserve Bank target band. But we must remind investors, actually inflation averaged closer to 5 to 5.25% longer term. So we think there's a risk that investors are getting mildly pro-cyclical, just given the low inflation environment that we've currently experienced. But just as a reminder that inflation should be top of mind, looking at some of these lower risk categories. So on the left, we have the lowest risk, and as we move through to the right, we get incrementally more risky. And just maybe highlighting the very safe and short-dated area of the market. And we can see contrasting that to 2019, where we are today, the real returns on offer have become significantly impaired. Looking at the right-hand side, we just perceive this is a slightly more risky area of the market. The real yields on offer are still very, very attractive. So how have we responded within our multi-asset funds? We have reprioritized our exposures away from these safe and short-dated investments. We're using we think, to a very effective degree, shorter-dated inflation-linked bonds as a cash alternative, and we're also taking advantage of the very attractive real yields on offer in the longer dated parts of our investment universe in terms of fixed income. Now, just as a case study and to lift the hood in terms of how our process works in practice, we are counter-cyclical investors. We are research animals, so we spent a lot of time assessing what we deem to be the intrinsic value of companies. And during these periods of very low prices, our process is very well suited to exploit when there's a very big disconnect between where the shares are trading relative to an assessment of intrinsic value. For this exercise, again, we just show the PSG Balance Fund, and we're taking all the purchases that we did during the year of 2020, aggregating that into an average price, and we're just contrasting that to where these prices ended in 31 March 2021. We're showing different segments in different areas of the market, but it's very clear to see our process in terms of counter-cyclically being able to take advantage of low prices. The subsequent returns in the round circled areas is an illustration just of the returns and the additive nature of what we provided for our clients. So I think this is a very good case study just in terms of our process, how we can take advantage of this environment. Again, just staying with the PSG Balance Fund, we'll just quickly look at our top equity holdings as of 31 March 2021. We also just want to highlight that this environment is a very, very fruitful environment for us. Our buy lists are full, and we're able to build very well-balanced portfolios, very attractive, high-quality companies that's priced very attractively. Looking at international equity, we have about 25% exposure there. And again, the market environment is providing us some very good opportunities to balance some more defensive equities with more offensive equities. AB InBev in this case, we think plays a good role from a defensive point of view, slightly more cyclical, but we think a very attractive longer-term growth runway. We have Prudential. Resources, we have about 13% exposure in the Balance Fund. We think that gold can play an additive role in the current environment, and we like the valuation of AngloGold Ashanti. Glencore, we really also like the commodity mix, and we think we are paying attractive prices for that exposure. SA Inc., we just have shy of 40%, but I think it's just worthwhile to highlight to our investors that about a quarter of that exposure, that earnings is actually driven from an international perspective. So if you carve out just the pure SA Inc. and direct SA exposure, it's about 28%. And our top holdings there, we have Discovery and Remgro. And then just lastly, we've had some exposure to international property, and we're incrementally now starting to look for opportunities within the local context. So now just aggregating all the blue exposures that represent international together, we take the 29% of our equities that's directly exposed to SA, and adding the fixed income segment, we actually see a very pleasing result where the balance fund has got a very nice balance between local and offshore, about a 50-50 balance, so no significant skew either way. And we think this is quite in contrast to a lot of portfolios out there that have a significant bias towards a perpetuity, a weakening rand. So this slide, we're just going to do a case study, and forgive me, this might be slightly technical in nature, but we think it's a very important showcasing of the strength of a multi-asset process, having the ability to contrast risk and reward, looking across instruments and across asset classes. And I think this is a very elegant example, looking at very long-dated inflation-linked bonds, and we're going to contrast that to the FINI 15 equity index, which is a good representation of an interest rate sensitive basket of shares in the South African context. Now, first considering the 2050 inflation-linked bond, this is a very long duration bond and can be very volatile. So one needs to be very careful in terms of the exposure and at what times, what valuations you access this opportunity. But we feel at sufficiently high levels of starting yield, this segment of the market can very elegantly start to compete with equity alternatives at much lower levels of risk. So we will run through a few case scenarios. We can look 1 year forward and just consider the range of outcomes one can expect from these two investments. So just from a status quo perspective, the 2050 inflation-linked bond is currently yielding 4.3%. And we know that inflation-linked bonds will accrue in line with inflation and provide you that return as well. So for this exercise, let's just assume this to be 5%. Taking the starting yield and assuming no change in rating, we will get to roughly about a 9% total return for the inflation-linked bond. Now the 2015 index, very similarly, it's got a starting dividend yield of about 5%, current rating about 1.1, and we've seen in terms of price to book, and we've seen even during very tough periods of time, these equities have at least been able to grow their book values with inflation. So adding that to the 5% dividend yield, the book value is growing by 5%, we get very, very similar status quo returns. So just very quickly what we'll do now, this is a completely objective exercise. We would just look at longer term history in terms of the different ratings these asset classes have experienced. What we do observe in terms of a downside scenario, incidentally, the lowest periods that we've experienced was the March-April lows of 2020. And we see on this basis, the inflation-linked bonds actually screen very, very attractively. Just considering a longer term average, taking the inflation-linked bond yield to 2.7%, we will experience a 45% upside scenario. And then very similar, looking at the longer term average of the 2015 index, it's about 1.5 times price to book, which will result in a 42% upside. Then just very lastly, we look at the 90th percentile. Again, the 2050 inflation-linked bonds, we think in terms of a range of outcome, screens extremely attractive. And we think we're getting this at much lower levels of risk, considering that inflation-linked bonds protect you against credit risk, and most importantly, inflation risk as well. So I think from a multi-asset context, and this is a very important example where we can look across asset classes and exploit this for our clients and our funds. Then just very briefly to close this section, we've spoken a lot about our offensive positioning, but we do acknowledge that we're quite surprised where we are relative to a year ago, the way markets are behaving, reaching all-time highs. We just want to illustrate, we always, front of mind for us is to build, given the inherent uncertainty of the future, this notion of building all-weather portfolios. So I'll just touch on the PSG Stable Fund. The blue segments and the pie highlighted there represents what we deem to be the defensive segments of our portfolios. Aggregating all of that together, we get to about 50%, so a nice blend, 50-50 blend between offensive and defensive positioning. The same old true for the balance fund, just in different sizing given the different time horizon of the fund. And very recently, we've introduced some measured use of equity puts just to overall balance our offensive and defensive stance. Just quickly in concluding, we think this is a very unique period and time for considering multi-asset funds. I hope that in terms of the case studies that we've shown you, the flexibility that these funds provide given the backdrop of significant market distortions. It's been a very, very challenging time, and the ride was more bumpier than we would have wanted for our clients, but we believe we've applied our process consistently, and it allowed us to take advantage of some very good opportunities over the last year. We've always had an absolute focus. I think in an age of market distortions, this is incredibly important. From a multi-asset context, many investors need to satisfy 3 to 5 year spending requirements, and having an absolute focus, I think, is quite key, considering how many other building blocks we think are actually priced quite risky. Then a wide and deep toolkit of asset classes, as we've shown. I think this dynamic allocation capability is extremely valuable in a world of distortions. So these flexible portfolios, we believe, can adapt to a changing market environment, and it should be well considered in this environment. We thank you for your continued support, and we look forward to taking some of your questions now. Thank you.
Okay, so the first question is around inflation. So if I think about our audience today, I would say that some of them might still remember the times that in South Africa we had inflation above 15, even nudging 20% in the 80s. Very few of us would remember in the 70s that America had its own inflation problems. But most of us will remember in the early 90s how Brazil's inflation spiked up to 70 and 75%. So inflation is one of the things on that wall of worry. And given that there's this massive stimulus and that we've got all this the jump in money supply and commodity prices going up, global inflation is generating a lot of debate. So how should we be thinking about inflation in the current environment, Justin?
Yeah, I think so, Nat. It's definitely a topic of our times at the moment. And I think for obvious reason. We kind of alluded to in the presentation the sheer extent of monetary stimulus. Central banks have been printing money at an accelerated rate. So money supply, almost whatever measure you want to use, is at really unique levels. We've never been here before. So it's kind of uncharted territory. And then at the same time, we've got fiscal stimulus as well. So governments are actually directing that into actual spend. So the most extreme example is the US actually wiring money to people's bank accounts. Half of them go spend it on Robinhood and do all sorts of funny things, but a lot of them haven't. So the big question is, is that going to be inflationary? And then we look at commodity prices recently. Oil price and copper, and a lot of people are talking, oh, flip, okay, is inflation a thing? I think from our perspective as an investment team, we'd probably say a couple of things. One is it's very, very dangerous to be too confident on this. We actually don't really know. I think it seems quite likely that we'll see, I would say very, very likely, we'll see a period of inflation. I think, even the Fed admits that. If you listen to Jay Powell, Warren Buffett most recently, said Berkshire's also experiencing real inflation. It's quite a nice barometer of the U.S. economy in real time. So I think just given base effects as well, we're going to see inflation. But that's not really the debate. I think everybody really appreciates that. I think the bigger issue is this going to kickstart a regime of sustained inflation going over time? And are we going to kind of have a bit of a repeat of the 1970s, 80s, Volcker to come in and stamp the cockroach? So, to answer that question, I think we don't know, but we would say a couple of things. The one thing I think to say is money supply has gone up, but we really need to see money velocity kind of really increase. And I think the jury's out on whether we're actually going to see that. For the first time, you're seeing actual fiscal stimulus, so that might be the trigger, but it might not. We don't really know. But there are three things that I think are worth just thinking about in terms of this. The one is, over the last decade, or 2 decades, you've had this massive deflationary impulse that have come out of Asia. So China, Vietnam, Thailand, they've really become the manufacturing hub of the world, and they've captured their low wages and exported that into the world. I think we've all benefited from that, through goods that we've imported and that we enjoy. Now, going forward, that might not recur to the same extent. In fact, we're seeing evidence that China's transitioning into a consumer-led economy. And I think what that typically happens then is they start consuming themselves. They don't export anymore. And I think that supply-demand balance might change. So that's just one thing to think about and one thing to watch going forward. The other one is you've had this, I think, extended period of multinational consolidation. And the most obvious example are these mega tech companies who have just been allowed to just get bigger and stronger and stronger. And what happens is when you have such a consolidated market positioning, they retain pricing power. And that's often why they are such good businesses and they're in demand. Now, what's quite interesting is going forward, as they have to start grappling with input costs and commodity goes up and wages are going up, it looks like there's a labor shortage in the US, they're going to start pushing those prices onto consumers. And we think that's an underappreciated dynamic that's worth keeping an eye on. So we think the consolidated corporation have been allowed to get too consolidated, and that might be an impetus for kind of sustained pricing power and sustained inflation over time. And then the third one is ESG. ESG's, I think there's a variety of number of opinions on it out there. And you can't do it justice in a short sentence. But I think the one interesting insight here that we would posit is that it's not going to be costless. It's going to come at a cost. And at the end of the day, consumers will have to bear that cost. And I think that's going to be a bit new territory. We're going to see what that looks like as they electrify the world. I think you're going to see energy prices go up, and people are going to pay for that. So we think watch the space. We would we definitely thinking about it from our portfolios as one of the biggest risks that we're looking to manage for our clients. So when we're looking to construct multi-asset portfolios, it's top of mind. We're trying not to be binary about it and put all our eggs in one basket. We want a nice balanced approach, but we think you'd be wise to have a positioning.
To build that into your thinking.
To build that into your thinking, yeah.
And thank goodness we're coming off a low base.
Correct.
That we're not coming off a high base already. So allied to that is resources. You're talking about the consumption of commodities and, countries like China and even, I suppose, India becoming more consumer-led. So do you have enough resources in your portfolio if there's going to be this magic super cycle?
So we think we've got quite a nice balance. And Dirk, in his section, I think, took you through that exposure. I think in terms of direct resource exposure, we've got about 13%, so it's around the mid-teens today, which I think is a nice, healthy exposure. But I think what's often quite interesting is, and that's kind of across some of your well-known miners. So we were able to add to Glencore last year. We bought Northam for the first time. And it's not your traditional kind of SA miners as well. Even on the global side, we found some really interesting opportunities in agricultural stocks. So a company called Mosaic. It's one of the leading fertilizer companies. It's interesting. Anglo American has just bought that fertilizer business, very, very small, as a bit of a growth option for themselves. Mosaic is the leader, in potash and phosphates. And those prices, as you can expect, are going crazy.
So you've seen already, some of that's already unlocked. But also what I think is worth noting is that you took advantage of that whole dislocation in the market a year ago to actually add to these. So the market gave you that opportunity to add at a time when people thought the world was coming to an end.
Just to add to that, the challenge with resources, you're trying to balance two things. On the one hand, it is a tool for managing inflation risk. So typically, one of the things we've observed over the years is periods of sustained inflation, commodities are useful, especially if you've got a fixed cost structure and you can sell into that inflating market, you typically do quite well. The challenge with commodities in general, though, is that there's also a very large China elephant in the room. And, everything's pretty benign at the moment, but when you have 80% of net demand in a commodity market like iron ore and even copper is a little bit less, from one country, if something happens there and they have a bit of a pause or they make a policy mistake and they tighten too aggressively, you could have a bit of a wobble. So we think putting all your eggs in a commodity basket is a bit risky, but we think we're well positioned there. And it's also worth saying that there's other avenues to that. And I think the one thing that people miss is that South Africa is fundamentally still very linked to resources. If we are going to have a commodity super cycle, which is not necessarily our base case, but we think it's in the distribution of possible scenarios. If that happens, South Africa will do very well. We're already seeing the early signs of that.
And not only the commodities.
Exactly. And what often happens is your second derivative company, so a big holding in our funds is a company like ACI, dominant provider of chemicals and explosives into the mining industry. And we think those, if you look at previous cycles, those have done very, very well. So when we look at our portfolio mix, it's not just the commodities. We actually would include a large swathe of our SA Inc. As they would be eventual beneficiaries. And I think a good case study is just look at the mid-2000s. The last time we had a super cycle, what happened in mid-cap South African focused shares from a low valuation? I think that it's quite interesting, and I think we've got that on, and not many people do.
One more question about commodities. You did speak a bit about Glencore. But can you maybe say why that one? It's got so many issues.
Yeah, it does have issues, but I think we own it for three main reasons. I think the first one is we like the commodity mix. We like the fact that they've got copper, zinc, very high exposure to commodities that will benefit from this electrification journey. And that's been largely ignored for the last couple of years, but this last 6 to 12 months, that's starting to gain traction. So we think that's a nice way to play it, and it doesn't have iron ore. Now, iron ore, we don't know. We got it wrong before. We thought iron ore was expensive last year, and it's kept on going up. But that's the one that's so far ahead of marginal cost that it just looks a bit risky for us to have too high an exposure to iron ore. So we think Glencore gives us a nice tool of having that exposure without iron ore. We like the marketing business. We actually think it's quite a high quality business buried in this miner. And then the third one is we think we can harvest this ESG premium for our clients as they transition, as they improve. They've done some things in the past that we're not happy with. I think the world is not happy with, and they need to change. And we're seeing the real impetus in improving. I think that direction of travel is going to unlock extra value as well.
So you can be a beneficiary of them moving to the right place, as opposed to the ones that are waving the ESG flag
you got
already.
two choices. You can wait for them to get there, at which point everyone appreciates it and the price is high, and then you pay that price and your returns from there are probably average to low. Or you can invest and be part of that transition, and I think clients get a better outcome there.
Okay, the next one, maybe Dirk, you can take this one. So let's say we believe that there will be inflationary pressure globally. What about our domestic bonds? I know you showed on the right-hand side they are quite a bit ahead of inflation. Is that enough of a buffer? Are you happy with local bonds in the context of global inflation?
Yes, so I think, again, for us, we are price-sensitive investors, and we do think that, starting valuations do matter. In light of the alternatives becoming very unattractive, specifically looking at the short or the most safe areas of the market, we need to remind ourselves that one of the bigger threats for multi-asset or lower income investing is the threat of inflation. Now, with the repo rate having fallen to about 3.5%, with inflation matching it to a large degree, traditionally investors have enjoyed significant real returns from those very safe areas of the market, and now that has become very different. So, very interestingly, we've seen a very bipolar response from the ASISA statistics, investors moving from equity into directly in fixed income and almost ignoring...
As the rates come down.
Exactly, yes. So this is a very bizarre response in a way. But I think investors need to think very carefully, looking forward in terms of, how they can hedge, the threats of inflation coming back, especially considering, the Reserve Bank, the potential for them to be accommodative for longer than expected. So we do think the yields on offer on the longer to mid parts of the government bond spectrum, we're very aware of the risks, but we think it's a risk worth taking in terms of, managing the threats of inflation for our clients and taking advantage of very, very good real yields on offer if you are willing to take a slightly longer perspective. We should also remind ourselves that equities are actually a very good hedge of inflation itself. And we actually think that's why multi-asset funds, I think advisors need to take a very careful look, especially in light of, this almost a completely underappreciated spectrum of those asset classes. Instead of moving from equity into fixed income, we think a very elegant solution, even for cautious investors, they should consider having some exposure to equities to help with that threat. And the funds that have flexibility to navigate or look for alternatives in a well-balanced way, we think can add a tremendous amount of value.
Just to add to that as well, I think we have seen some volatility in our bond market recently. And I think some of that is you've seen higher US rates and people getting a bit worried. Our sense is probably there's enough of a gap between our nominal yields and we're very still close to very, very high level. So there's a big margin of safety there.
So you can buy and hold it at 8.5, you can buy and hold it at 9.5.
But it's not without risk. So yes. if we really get a 1970s, 80s out of control environment, we'd have to probably rethink that. But it's worth bearing in mind two additional things. One is a little bit of inflation is actually very good for us. Mm-hmm. So you can import a bit of inflation into South Africa, and a bit of that adds to nominal GDP growth, and that can actually help soothe our fiscal issues quite quickly. There's nothing better at addressing a debt to GDP problem than a little bit of inflation. So we actually think, weirdly, that could actually be a good outcome. Remember, the biggest reason in our assessment for the very, very wide yields that we've got is actually a fiscal premium. People are worried about the fiscal risk.
Yes.
And if that gets addressed, that could go away. And then the last thing is, Dirk mentioned in his section inflation-linked bonds. Part of our bond package are actually linkers. And we think that's quite an elegant way of harvesting the high real yield, but you got that upside participation if inflation overshoots. So it's not our base case, but if that happens, we think that could be very valuable parts of the portfolio as well.
Okay, so just on the questions again, thanks everybody for sending so many. We've tried to consolidate them, and again to remind you that if we didn't get to your question, because we're kind of blurring some of the questions now, if we didn't get to your question, please do email your fund specialist. So the next question was about the repo rate cuts and cash returns being very low, credit spreads looking very thin, and that's of course because people have pushed a lot of money into credit in income funds. And I think Dirk has answered that question around the the danger of the previously safe assets. I don't know if you want to add anything to that. You're happy with what you've said?
No, I think we've seen a very interesting dynamic just from a supply and demand perspective. At the same time where the repo rate has been cut to the significant degree it has, leaving very little real returns left on the table. At the same time as the fund flows have moved into the lower risk funds, and these funds use to quite a wide extent credit instruments as well. A lot of that credit instruments are actually issued by the banking sector. And what we've observed is just an enormous flow of deposits into the banking system. And given the weak macro backdrop, the banks have not been able to lend out to the same extent as their deposit gathering. So that meant that the banks actually, in terms of funding requirements, their wholesale funding requirements has contracted at the same time where there's a significant demand for enhanced yield exposure, which is in the credit market. So the credit market would typically price off the repo rate, which is low to begin with, and a spread. And that spread today has become very, very low just given the supply-demand mismatch. We're very cautious considering that sector. It's not the most liquid sector at times. And we do think that when some of this tailwind dynamics in terms of fund flows and the economic recovery starts to happen again, and the wholesale funding needs of the bank starts to increase, we think there's some risk of that dynamic reversing. And we would rather be waiting to take advantage should this dynamic reverse.
Great. And the next question we have is, this is a great one. Markets are high, markets are looking frothy. Why do you have so little cash?
So it's always a very difficult question to answer. It's impossible to say how the market dynamic will unfold. However, we are surprised, just considering where we were a year ago, just how broad-based indices are looking. Again, it's very difficult to forecast into the future, but we do acknowledge there is some froth, and things do look elevated. So we think, we think there is some risks around. So one needs to be very mindful of that. At the same time, we see a credible divergence in terms of uncrowded opportunities in the market. Are we taking advantage of that? Our bottom-up signaling is suggesting there's really good opportunities to be harvested for our clients. So we're mindful of the overall dynamics, and we're very sensitive to building, or this concept of building all-weather portfolios. So we're always looking for those elements that can provide some protection in our portfolios as well. So our cash balances are low, but we're using the shorter dated inflation-linked bond market as we think a very attractive alternative to cash.
Okay.
On top of that, we're also utilizing, I think a large part of our toolkit we are utilizing, but we can also say that we've, on the equity side, we think gold can play quite a defensive role. And we've been able, over the last year, just given the opportunities on hand, we've built quite a nice exposure to quite defensive equities as well. And as discussed, we've introduced a very measured amount of puts on the equity side as well. So in summary, very difficult to say how the future will unfold, but we think it's always top of mind, and we're trying to strike an adequate balance between offense and defense. And we think, relative to our mandates, we're always trying to calibrate that.
Because we've got some good alternatives to that low cash holding. Recently, we wrote an angle called "Don't be fooled by the tide," which actually illustrates this bifurcation, which says the market itself might look frothy, but you have to look within the market in which parts are expensive and which parts have been left behind. I think we've got time for one or two more. So you mentioned the puts that were put in the portfolio. So we haven't used derivatives extensively in the past. We've used it in some of our funds. Can you maybe, Justin, you can expand on the role and why we think there's an opportunity to use them in the current environment as opposed to maybe 2 or 3 years ago?
Yeah, no, great question. So I think the easiest way to answer that question is what we're really trying to do is we typically have a preference for cash. That's typically, if you look over time, that's been kind of the bedrock of our process. And what cash does is it basically gives you an option to buy assets cheaper if they fall in the future. And at the same time, you're often earning a decent yield along the way. Now, what's changed is, as kind of Dirk alluded to, is the cash has become very expensive. The prospect of returns from cash are very, very poor. So that insurance that you would get from holding cash has become very expensive. It's gone up. Now, what we do is we're always kind of evaluating the different alternatives we have in front of us, and derivatives are quite an elegant alternative right now. So what you've got is you've got very high markets, driven by a lot of these kind of bubble behavior, we never know when they're going to crack, but they look a bit stretched.
In parts.
In parts. But I'm talking about the aggregate market index. So the S&P 500 is a good case study there. And implied volatilities, which is loosely, the cost of that insurance has gotten really low. So actually you can buy some decent protection. So what we've done is very vanilla put options that protect you if markets kind of really, really get a knock. And what we think that does, if you put it onto our portfolio, is if it doesn't work, and it means that we pay away a little bit, and it often means that the rest of our portfolios have done very well. If we do need it, that insurance we're very, very happy to pay for. So it's quite a nice, elegant solution. It's not something we're going to use all the time. We're kind of at that particular moment now where we're trying to balance the opportunity set we've got in our funds, which as Dirk said, we think is very exciting. So in order to help us kind of take advantage of that, to have some market protection at the top level, just to kind of control market risk a little bit, seems very sensible to us. So that's kind of where we are.
Okay. The other one, you spoke a little bit about property. So we haven't had property in the portfolio for quite some time. Now we're getting a bit more interested in it. So maybe just talk about one or two of the opportunities in that space and why we're interested. I mean, if, there's this prevailing belief that no one's ever going to go to shopping centres, you don't want to be a tenant. You want to be a tenant, you don't want to be a landlord at the moment or ever in South Africa. Why would you be interested in property?
Yeah, this is a very interesting space. So we have a global process. I think that's quite useful. We can see what happens around the globe. We've had some offshore REIT exposure prior to COVID. A lot of the fundamental concerns of the world moving to more of a digitized world, those concerns were very well reflected looking at some offshore property companies. And that's why, we felt that was a good area in terms of looking for opportunities, and we've been successful there. The South African property market, quite different. It had a rough time, but we felt that in terms of some of the fundamental concerns that have been building up over the last decade in the local property market in terms of the supply dynamics and the dynamic of continuously growing dividends at the expense of not looking adequately to your balance sheet structure. A lot of that got accelerated during the COVID crash. We feel that it's still a very idiosyncratic environment. So in terms of our process, being able to assess company by company, I think is a very fertile ground to be looking. We're very, very selective, but we think in terms of a stock picking area of the market, it's very, very exciting. So we've been very measured. We've been adding into that space. And we have a mild bias for the retail sector. We think our dynamics are quite different to that experienced globally. And we think there's a bit of excessive pessimism there, but we're very carefully looking at on a case-by-case basis.
So the exposure is still quite small?
Relatively small, but we think it's a fertile ground for us to be continuing to look for opportunities.
Good. So now performance has improved over the last year. Justin alluded when you started in saying that our funds did much better than the average over the last year. We've seen a very good recovery. But can you help investors with a bit of context around the periods of underperformance and why it's working now? So some changes investors would have seen took place in the portfolio during the first quarter of last year, especially into the crisis. Took advantage of that opportunity to restructure the portfolio to some extent, to take advantage of shares that were previously too expensive. But what has got us there, and why have things worked over the last year?
Yeah, thanks for that. So I think it's useful just to kind of step back a little bit and think about the journey. So the journey over long periods of time is that our process has typically delivered quite good outcomes for our clients. I think across the fund ranges, that's been the case. What you've seen is over the last 2.5 years, we've had a really challenging time, particularly up until March last year. That was really kind of the bottom for us. And it's been very challenging. I think it's worthwhile just thinking broadly on why that has been. And I think there's kind of three things we would point to. And what's quite interesting is they happened all at the same time, which when that happens, it becomes even more painful. So the first one is the global environment was quite challenging for the way we manage money. So interest rates very low, inflation very low, passive emerging as a very powerful theme. And what that's done is it's embedded a very strong momentum and growth theme into markets. And what that's basically, the nitty-gritty of it is that the price you paid didn't matter so much over the last few years. So if you just bought what was popular, you did great. If you tried to be responsible and you thought that price mattered, like we were stupid enough to do, you didn't do so well. And so that's the first thing that happened. And that happened at the same time as, we did get a couple of stock selection calls wrong as well. And I think we've written and we've spoken quite a lot about those, particularly in 2018 and 2019. We haven't, unfortunately, that hasn't been a thing more recently. But we've spoken about things like Tongaat and EOH before, and they kind of coincided at the same time. We will occasionally get stocks wrong. I mean, we were living in an uncertain world. And typically you'd hope to get most of them right, and that's sufficient. But those two kind of working against us at the same time as the global backdrop was challenging. And then the final piece, really as the cherry on top, was COVID came out of the blue, and what it did is it really whacked portfolios that were positioned in companies that had a bias towards human activity as opposed to digital activity, so more analog and less digital. And that's really where we had been finding opportunities. That was where prices had gotten, in our assessment, too low. And we had been avoiding those parts of the market where we thought people had gotten a bit too excited. And so that timing angle was quite painful for us. So that all combined into quite a challenging time. Now, fortunately, it looks like it's been proven to be temporary. So we've, the last year, we've seen some good progress in terms of getting back on track. But we do think there's a lot more to come. I think we're still not satisfied with where we are. We're definitely not sitting back and celebrating yet. We think we're in the early stages of our performance cycle, and alpha does tend to be somewhat lumpy. That is just the nature of a somewhat differentiated process like the one we have. But we think we're in quite a good space right now. So, to answer your question in terms of what's actually been driving it, it's quite interesting. The single biggest event that probably led to a change in the fortunes of investors in our funds was probably the announcement of the vaccines in November. And what that did is, I think for the first time, is markets participants were able to extend their time horizon just a little bit forward. Up until then, people were so focused on, geesh, we're in trouble. I don't have any time for your talk about cheap assets that might recover one day. Like, I just want Zoom and I want Netflix and I want stuff that people are using today. Yeah. Doesn't matter what price you paid. And I think that changed. So that was really, we always say catalysts are impossible to forecast. We had a suspicion that
vaccines. So with hindsight, you think that was it?
We think that was it. Yeah. I mean, it looks like that was a very important development in markets. I think these things tend to roll. So the next one is probably going to be as actual economic activity opens up. So initially, it's just been the markets running ahead of reality, as they always do. Markets are always forward-looking. And I think what you're going to see now is you're actually going to see markets opening up, activity rising. You're going to see the most number of, the stat I saw is we're scheduled to have the most number of weddings in the US in the second half, in the summer.
After probably the most number of divorces coming out of last
exactly. Maybe it's a bit
year.
of catch-up. But I mean, so much of your life was put on hold. Yeah. People weren't able to celebrate milestones. And now they've got money in their pockets. Not everybody. It is a bit of a divided and unequal world, but in general, households are in pretty good shape, and we think people are ready to spend. So be prepared for some degree of boom times would be our assessment. Yeah. Now, kind of bringing that into our portfolios, our process gravitates to companies we think are actually good. We don't try and buy junk. We really think what we're trying to do is we're trying to buy companies where the growth and the quality aspects are just underappreciated by the market, and what we think what happens is this environment is going to make that more obvious to people. People will look at something like AB InBev, who they'd written off as a low-quality emerging market dog.
Well, it certainly goes with weddings.
And all of a sudden, people can say, actually, this is actually a really high-quality company that's de-gearing.
So what happened is that the old normal isn't going to be the new normal, but the things that people the new normal things such as weddings and going out and traveling and going on holiday and going to restaurants, those companies were just written off.
They were.
And that's opening up now. I think we've got time for one more question. This one's from me, not from the audience. For those people in the audience who are not yet investing in our funds, what are they going to get wrong by not investing? What's the bull case for our funds? You've got to have a strong closing year.
Yeah, it's a very, very very interesting question. I mean, I just to kind of give a bit of light into our process. When we evaluating a company or an equity opportunity or even a bond opportunity, we spend a lot of time looking at what could go wrong, so the downside risk, and make sure that we discharge those as much as possible, or at least are aware of them and price them in. But we also make sure not to neglect the blue sky, the right-hand tail of the distribution. And we spend quite a lot of time thinking about what is it that could happen if a couple of things happen in combination that would really blow this out of the park in a positive way. And we think that's an important part of a process, because if you run an equity process and you're only worried about left tail and central, and you sell before things get exciting, you never capture the right-hand tail, you're going to have a skewed outcome. It's going to be working against you. So it's important that you capture that whole distribution as much as possible. And we think our process is set up to do that. So, I mean, applying that lens to our funds, I think we've spoken at length about kind of where we are at the moment. But I just want to paint a couple of concepts. I mean, the one is it's going to be a feature of the market environment, so the economic environment. The other one is going to be market structure. I think if you combine the two, you could get an interesting outcome. So the first one, just think about a little bit about the economic environment. We've alluded to the potential. We're not saying it's definitely happening, but there's a potential that we're in for a number of years of roaring 20s type economic activity. So synchronized growth, very accommodative policy, interest rates will be low. I think what you're going to see is you're going to see a spending bonanza. And nominal GDP growth is going to be, on a synchronized basis, very, very strong. And I think what that's going to do is we'll be very well positioned for that, because we're largely positioned in companies that have been written off. Maybe they're going through tough patches.
Real economy companies.
Often real economy companies, exactly. And what we've seen early signs that those companies can do well. And what's quite interesting is that they still had very, very low valuations. So if you look at a lot of the companies that we own, they might have done well on a 6 to 12 month basis, but they're still 60% below where they were a couple of years ago. So that gives you a bit of a sense. So there's the economic environment which needs to play ball, and part of that is inflation. So we've spoken a bit about inflation in our first question. And if that happens and you have commodities, a commodity super cycle, we think our commodity exposure could do quite well. We think our bonds would do well for the reasons we said. And we think our South African shares could actually benefit almost by stealth, almost as a second derivative of a commodity cycle. So there's a couple of thoughts there. Then you've got market structure. And this is where it gets really interesting. So what's happened over the last 10 years is low interest rates, passive, and just the consolidation. So you've had big funds staying big and small funds kind of losing ground. What that's done is it's forced average positioning to look very, very similar. The big guys are kind of all forced to own the same stocks in our local markets. They just are. They might love a small cap or a mid cap, but they just can't make it count. They'd have to buy 80% of the company if they wanted to actually count in their funds. So you've got almost this setup where markets have gravitated to the same number of stocks, which, as it happens, have all done reasonably well over the last 5 years. So large commodity shares, Naspers, Prosus, Richemont, British American Tobacco is the other one. It hasn't done that well recently, but it's kind of in the mix. And there's this tail of opportunities which people are just not able to access. And that's kind of, we think, where we come in. So Dirk has mentioned our process. We absolute. What that means is we're not looking at a benchmark or an index to construct our portfolios. We blank sheets of paper, and we'll really try and populate it with our best individual ideas. So that's the first one. The second one is that we tend to look quite different from the average manager and index out there. And what that means is that your performance can look quite different. So we've seen the downside of that in the 2 years up until March last year. But what you've seen more recently is when it can go right. And we think that's the real bull case, is you've got a differentiated product, something that especially when you blend it with maybe some other funds that have different characteristics to us, can really add a lot of value to kind of a consolidated savings or savings solution for end investors. So those are a couple of ideas in terms of where it could go right. We don't think we need the South African economy, to have a cyclical boom. We think prices here are so low, sentiment is so low, you just need a mild stabilization and a bit of a recovery, a bit more good news. ACE getting ditched, a little bit more of that, maybe a cabinet reshuffle. I think, as I said, baby steps. But a little bit of confidence can go a long way. Those prices are still very, very low.
I'm going to have to stop you there. Thanks very much, everybody, for your questions. Thanks for attending. If you have any more questions, please do email them to your fund specialist. Thanks again for joining us. We'll see you next time.
Something that she thought she could understand, but that was way before her heart was broken by a man. Oh, she's crying. Oh, I see her dying. The clouds are coming in, and as she cries into a river, stars are shining bright. Only when you couldn't see her, oh, she's hiding.